Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow. And this quarter is finished, but we think the next quarter is the one that will have a lot of activity in it and a lot of things going on. If you look at the economy, just sort of plods along in here. We'll get into that a little bit. Some things good, some things bad. Is the Federal Reserve making a mistake? Probably, maybe. We think there's a good chance they can. I think they misread a lot of things. And there's quite a bit of hubris in that group right now, so we'll have to see what happens there. And then the insanity of the political situation for the next quarter, really. It's almost like if it wasn't so serious, I'd call it a cartoon, but it's really has people on both sides upset, undone, worried about things, and so that's affecting things as well. And then there's a lot of changing dynamics in the investment markets themselves. And we'll get into that as well. One of the things we'll get into first, though, is the economy in general. So let's just take a look at the job market, for example. And if you'll notice the green line, the U.S. government's been hiring more people than anybody. I don't know if it's politics or what it is, but they've been in the marketplace in 23. They've been back in the marketplace and continued this upward move here the last 3 or 4 months in terms of job openings and government job openings. One of the things, though, if you look at jobs plentiful, consumer confidence, consumers don't really have a lot of confidence that there's a lot of jobs that they can get out there. So that's going to be a problem as they go along. Let's flip over to housing, particularly residential. But if you look at pending home sales, they're very, very low right now. And everybody's thinking, oh, we're going to lower rates and things will be fantastic. We're going to get the long-term rates down. But it hasn't really affected the sales side that much. One of the things that has affected, though, is refinancing. Refinancings have gone up. This is a one-year graph of refinancing, and they've gone up. The problem is, if you look at where those mortgages are, the great group of mortgages lie between 2.5% and 4%. You have to go a long way before you affect those people. So the refinancings will have an impact for a while, but we don't think that it's going to be a major game changer unless you have something greater than what we've seen so far. And lastly, if you look at the average consumer today, they're spending two-thirds of their money on 3 things. If you look, housing, transportation, and food. That leaves nothing else around. You're talking about insurance, children, schools, whatever. And that's why you see this situation where the consumer in non-mortgage debt has increased more than mortgage debt over this last period. And that continues to be the case today. One of the things that's driving prices, though, and unfortunately, I think both of these candidates for office in Washington are going to want to put on tariffs, is that we've had tariffs in the last 2 administrations. All that does is increase prices for people. It's economics 101 that's not what you do. And yet we want to try to do that with the idea that, hey, we'll bring everything back to the U.S. Well, that's not the way it works. You end up paying a lot more money for things that you use day to day when somebody else could produce it cheaper. And free trade is a major thing in economics. So if you move on and let's look at commodities, and this is one of the big changes we'll talk about, and you'll see it in the market letter that comes out here in a few days. Commodities relative to the stock market, and we only have the Dow Jones going back to 1900, but if you look at it relative to the Dow Jones Industrial Average, they're cheapest they've been in 125 years on a relative basis. And if you're any kind of a contrarian at all the next 5 to 10 years, you have to start to think about that. There's going to be a shift change in what goes on. The other part of that is oil. We own a fairly high concentration, not overly high, but we own quite a few oils and we own quite a few pipelines. And if you look at oil inventories, they're basically at a 13-year low. In addition, the Strategic Petroleum Reserve is low. They spend it all. So while it may be weaker short term if you get into an economic break, long term, oil has to be looked at as one of those things that you put in that commodity basket. So if you go to bond markets, and I put this in there, we followed the debt clock here for ever since it's been out almost. I go all the way back to, $1 trillion in debt. But if you look at what's happened here, and I put up here 2012, We've gone from roughly 16 trillion in debt to 35 trillion now, which is, do the math, it's about 1.7 trillion a year. And one of the problems with that is we don't see an end to it. And both of these parties that are going in are going to spend more money as well. Because if you look at what's happening, both of the last administrations have run very high deficits within a time when things weren't really horrible in a horrible, horrible recession. So my point would be is that that's probably not going to get any better. So what have we done in the bond portfolios? Not a lot, but over the last 4 to 5 months, we did do this. You'll see here a yield curve in June 1 of the U.S. Treasuries from really 3 months all the way to 30 years, and you'll see now, okay? What the red arrows are, you'll see where we moved out back then, we moved out and bought more 9-month, 1 year, 15-month, 18-month, and 2-year Treasuries to lock in 5% on everything. A few of them ended up being about 490, 495, but you can see that it paid off because we've had this move down in the short rates. We haven't done a lot on the long end, but we want that short end locked in for a while to see which way this thing goes. And then lastly, gold. And we own, in all of the income portfolios, we also own a position in gold. And if you look at gold over the last 25 years, and you might not think about it this way, but it's outperformed the bond markets, the stock market, and the dollar. Now, there's been periods where it didn't do a lot for a while, but gold is meant to be owned long-term as a hedge. And so one of the things we put in the market letter this next week, was this. If you bought the average home in the U.S. 20 years ago was about $187,000 for the average home in the U.S. It took you about 451 ounces of gold to buy that home at that time. Gold was about $415 an ounce. Today, it takes you only 156 ounces of gold to buy that very same home. And if you just want to look at the numbers on it, that gold number today, 451 ounces, would be worth $1.2 million. And you see, it's a point of holding it. It's not a point, and you say, well, I can't get any cash flow on it. Well, I know a lot of great investors that own a lot of things that on the short term they don't get a cash flow on. I'll just take raw land, for example. I know a lot of people that pay cash for raw land. Good piece of land, they're going to make money on it in the long term, but the only thing they pay on it right now is taxes. They don't get any cash flow. Seen the same thing in oil and gas and a number of things. If you buy the right thing, you can afford to hold it. Well, gold is in that same category. So if you move on to the stock market, I know this is a cartoon, but this is really what people think. Jay Powell to the rescue. He rides in on the bull market and everything goes back to normal again. And that's the big era of this particular Federal Reserve group. They actually think they can manipulate everything. And this machine is well too big for them to try to really produce the hubris that they produced in trying to do this. Give you a good example right now. If you look at price to sales on the S&P 500 companies and on the NASDAQ 100 companies, you'll notice the price to sales where it is today, and it's almost twice in both categories. It's twice what the average is. In other words, people are paying a lot of money for these companies, and so you have to be really particular today about what you buy. I'm not saying you can't buy anything. We bought things, but you can't buy everything. That's one of the problems you get into. The other problem is that everybody's in. If you look at the number of people invested in the marketplace today, and by the way, for people over 65, it's an all-time high that they've got financial assets in the stock market. And they're thinking, great. They're thinking, hey, you know what? I'm going to spend some money. I've got money in the markets all-time high. My real estate looks good. So they're really feeling good about it. Unfortunately, that kind of thing comes when markets are in full-blown, full highs as opposed to full lows. And then if you look at investment advisors, they all think that the equity market won't peak till much later on. And this is a whole group that look at the whole picture and see what's going on. And unfortunately, this group that's in our industry has never gone through much of a commodity cycle, so they really don't know what to do. They won't know what to do. Markets stay flat a long time, commodities go up, throws a lot of company margins out of whack. And I think that's one of the things you'll get in or start to see here. The other thing, and Chancellor New can use this graph, last week, but if you look at the Federal Reserve going into when they're going to lower for the first time, which they just lowered 0.5%, if the markets going into that are down 10%, you get a big boost from that. But if the markets are up greater than 10% over the past going into that, you get virtually nothing. And we're much over 10%. So the idea that you're going to get a big boost from that is a bit far-fetched, I think. And then if you look at investment advisors, people in our industry, if you look at the top 3 things they own, Apple, Microsoft, NVIDIA, they all own the same things. And they'll all recommend the same things. You'll see that it's like a broken clock. Just keeps on saying the same things every time you listen to it. The problem is that when you turn the tide and everybody owns the same thing, if you don't own something different, it's probably going to affect you. And just to give you an idea, and these are 3 things that people, that same group, they owned, well, they loved these stocks during the pandemic, which was Zoom, DocuSign, Peloton. Well, look what happened to these. That's what happens in this sort of stuff. You get caught up in these. They really get too much emphasis on those things. And lastly, on the gold mining stocks, okay, we own a lot of gold mining stocks, but they are still very cheap on a relative basis. If you look at enterprise value to EBITDA, they are very cheap relative to the S&P 500. And so we think they have a long way to go relative to go. Then they could get sell-offs and that sort of thing, but that's something to keep in mind. To wind up, so you know some of the things we've been doing, okay, if you just look at some purchases we made during the quarter, you'll look on the stock side, you'll see we added quite a bit of energy, added VeriSign, we added a couple of utilities. One of the things that's different today than any other time in the country is this. Electricity demand is going to go up huge over the next 5 years. And if you look at major electricity demand and you go to these public companies, they will tell you they line up people that are having to go out now 2, 3, 4 years to get in line to get the electricity they need. So owning the electrical companies today is going to be better than it has been, I think, in the last 20 or 30 years. And they pay nice dividends on top of that. In the high income accounts, we added to the REIT we have, their favorite is Health Peak. It's basically medical buildings everywhere. I think it's really well run, pays a nice dividend. 2 of our fertilizer companies, Mosaic and Nutrien, both pay nice dividends. Fertilizer, obviously, is one of those that it plays in the commodity market on both sides, the inputs and the outputs. And then lastly, you'll see we moved the bonds from 3 months to 2 years and laddered those. So we're doing things, but we're not doing the things that everybody else is at this point. And one of the things I think you're going to see today is that with the proliferation of what I call wealth management, and I'll just use this phrase, it's just money, money, money everywhere. You can't go 2 blocks without seeing a wealth management, wealth advisory office. You can't see it. You attend an advertisement. Every TV channel has it. Every magazine has it. Every newspaper has it. We are so locked in financial assets today that the change that we see coming eventually, it will shock this industry as well because they really don't know what to do in those situations. I say that to you because I think in the next 5 years you need to try to think about what you want to add in your portfolios to give you more balance. Hopefully, if you got something out of this today, you'll have an idea where we are. And I will tell you, this next quarter is a crazy quarter. You've got 2 wars going on, which could escalate on both sides, 2 elections that who knows. You've got world economies upside down. There's a lot of things happening in the next 90 days. So I would say to you, be careful, watch what you're doing over this next 90-day period. But if you want more information on what we talked about today, please visit our website at oxbowadvisors.com or give us a call, and we hope to see you next quarter. Thanks. Hello everyone. I just want to say if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.